Hey guys, Omar Khan here from Theta Trading, and today's topic is going to be bonds explained for beginners, aka Bonds 101. Now, when I was beginning my investment journey and learning about the world of finance, I had very little understanding of the bond market, how it worked, why it worked, and also what's its relationship to the stock market or the real estate market. Didn't really know a whole lot. So today we're going to talk about that. But before we do that, if I could ask you guys a big favor, if you would consider hitting that like button so that this video and others like it are promoted to people who are seeking financial independence, just financial journey, financial well-being, and mainly financial literacy. Also, if you like the content we're creating, consider hitting that subscribe button. We're trying to get to 1,000 subscribers. We're almost there, and once we do that, our videos will be promoted a lot more, so your help would be greatly appreciated. If you have any questions, comments, please put them down below. Also, if you want to book a call with us to find out more what we do here at Theta Trading, please do so in the link below. Now, let's get on to bonds explained for beginners. Now, what exactly is a bond? Bond essentially is when you lend money to somebody, they're going to pay you some interest for lending that money to them. That's really what it boils down to. So you could even have a personal loan you lend to your buddy. That's kind of like a bond. Hey, I'm going to lend you $100 and pay you back 105 a year from now. You don't usually do that with friends and family, but that's kind of the idea. Now, depending on how that friend or family member is, that is the credit worthiness. Is this person going to pay me back? Are they not going to pay me back? That's kind of how a bond works in a very simplistic term. Okay, now there's two types of bonds. One is corporate bonds, okay, so think of companies that lend out money and they're going to pay you a fixed exchange rate. They're going to say, okay, we're going to lend you something so you can lend money to Apple or Microsoft or any other company that you want that has a debt program, and they will pay you a certain amount of money. That's called the yield that you get. So if you ever look at a bond, you look at the yield, that shows you how much they're paying you. Now, the other type is a government loan. So you can lend money also to the government. So you can buy a corporate bond or a government bond. Now, government bonds are considered more secure. Why? Because governments, although they do go bankrupt sometimes and don't fulfill their debt obligations, it is much, much rarer. Corporations, however, they go bankrupt every so often. Every so often a company goes bankrupt and they owe you money. Well, that money may be at jeopardy. So that's kind of like credit worthiness we're talking about. So that's what it is, guys. That's what a bond is. You are lending money to a certain entity for a certain period of time. In exchange for that, you are being paid a certain interest rate. If you are lending money to a corporation, generally speaking, you're going to get paid more because the risk of default is higher. Now, if you're lending money to a government, generally speaking, you'll get paid less, but the risk of default is also lower. Now, what exactly is yield and risk? Okay, so like I said, if you lend money to somebody who is, not as creditworthy, you're going to get paid more, okay? So generally speaking, let's say it's a smaller company that, that's trying to grow their business. They're lending out money they're asking for, and they're going to pay you a certain amount. Now, you would expect them to pay you a lot more than you would expect, let's say, the United States government to pay you, because the United States government has never gone bankrupt and hopefully never does go bankrupt. So your money is very, very secure. So yields can vary substantially. You can get a very high yield. There's also something called convertible debt. So in a corporation, sometimes what corporations will do is they'll sell you a bond. They'll pay you a certain amount, but they'll also say, hey, in the future, you can convert this to stock at such and such price. That is called convertible debt, and that is issued oftentimes by corporations, obviously not by governments, because there's no shareholders and there's no company to be issued. So how do you choose a bond? Well, you can buy individual bonds, or you can buy a bond fund, or you can buy a bond ETF. There's different ways of doing that. Now, what you want to look at is, like I said again, creditworthiness. What is the likelihood of someone defaulting? And how much am I being paid? Now, for us as individuals, it's very difficult for us to be able to rate a bond and its creditworthiness. Luckily for us, there are three major rating agencies, okay? Now, one is S&P, Standard & Poor's, one is Fitch, and the last one is Moody's. Okay, now these three major rating agencies, generally speaking, they'll rate bonds of both corporations and governments around the world, so you kind of know what you're getting. Now, one thing I will say though, having been around in 2008, 2009, the last time we had a major economic decline in the United States, a huge, huge one actually, and there's been other ones as well, but that was really big. It was called the Great Recession. Now, what I didn't like back then is that the rating agencies knew that the bonds and the underlying debt were toxic and junk. So what happened back then is that A lot of mortgages were loaned out, oftentimes with little or no due diligence, no underwriting standards, just lent out to anyone who wanted a loan. These mortgages were packaged and sold as AAA rated bonds to various agencies around the world. Okay? And because there was real no underwriting done, these mortgages were crap. They were going to default. But the rating agencies all had them rated as AAA. Why? Because they were getting a lot of business from these investment banks. So I always take a grain of salt with what these rating agencies do, because I saw it firsthand back then. They knew these assets were not AAA, and yet they ranked them as such. Now, that being said, they are rating agencies, and besides that one instance, which was a big instance, I have found them to be fairly decent. But that one was a big one, and that did, for me, that still raises eyebrows to this day, because there's no way you should have missed that. You should have known exactly what was going on there. Total miss there. Okay, so generally speaking, you have bonds which are AAA rated. That is the highest quality of debt you can get, so you'll get the lowest amount of payment generally. Think of, U.S. government, short-term lending money to the U.S. government. That's going to give you your highest degree of safety, but your lowest return on your money. Now, once you get past the A's and you move into the B's, those are called investment grade or junk bonds. They used to be called junk bonds. That just means corporate. They're not your AAA. They're not your best. They're your second best, okay? Now, these, think of lending money to a company like Microsoft or Apple. Big companies, highly rated, also likelihood of default very low. You'll get paid more, but not the same degree of safety as, let's say, the U.S. government. Now, also, if you're looking to invest in a state bond or a provincial bond or a bond of some country, those will vary depending upon the creditworthiness. So that's what you kind of want to balance. What is the creditworthiness versus the amount of yield that I'm getting, the risk that I'm taking, okay? Now, how exactly does one go ahead and buy a bond? Like I said, you can buy a bond fund, you can buy a bond ETF, or you can buy individual bonds. I don't like to buy it, and I have never bought individual bonds, because to buy an individual bond is not an easy thing. Yeah, there's a certain cost. Now, no matter what you're going to be buying, you are going to have a brokerage account more than likely. Think of a TD Bank account or Interactive Brokers where you can house this. Now, if you're going to buy a bond itself, you definitely have to have that. Or you could, like I said, buy a bond ETF. Now, the benefit of buying a bond ETF is you're going to be able to get a bond exchange traded fund. So you can buy a bond exchange traded fund that holds corporate bonds. So you're going to get a whole bunch of bonds, which lowers your risk, because if one company defaults, well, your investment is still going to have other investments backing it. The same thing with government. You can buy a bunch of government bonds. So you get a little bit of the good, really, really good stuff, and you get some a little bit not as good, but the yield will be higher. Now, this has to be looked at on an individual basis. Sometimes there's government corporate bonds mixed into a bond ETF. That is all things that you can do. Now, there is an inverse relationship between the bond market, okay, and generally speaking, interest rates, okay? So if interest rates go up, bond prices go down. Bond prices go up, interest rates go down. But bonds mature at a certain price. So as long as you hold them, they will mature there. Now, I know it's kind of a hard concept to understand, but generally speaking, again, like I said, think about it this way. When bonds go up, okay, bond yields go down. Okay, but it all matures at 100. Now, you have to basically hold a bond for a certain period of time for it to mature at par or 100. In the meantime, depending on yield, it can go up or down in price. So sometimes you see bond prices going up or down. You're like, why is it doing that? Well, that's exactly why, okay? Because bond pricing changes based upon the yield changing, i.e. interest rates changing. In the last year and a half, we have had a lot of increase in interest rates, which means bond prices were pushed down substantially in 2022 and performed very poorly as an asset category. The poorest they've performed, in fact, since 2008. So now, how again do you go ahead and buy a bond? Well, like I said, if I'm looking to buy a bond, it's going to be through a bond ETF. And now, what we do here at Theta is we write naked puts and covered calls on positions we want to own. Now, did you know that you can write a naked put, i.e. you can agree to buy a bond ETF, in this case TLT, that's a big bond ETF. You can write puts on that and get paid just to agree to buy that bond ETF at a lower price. Now, again, you have to make sure that you're comfortable with what's in that bond ETF. But the point is, you can deploy the Theta strategy on bond ETFs, which is fantastic. Okay, so I hope you guys take advantage of that and use that and look at, if you're going to invest in bonds, why don't I look at adding some options in there to give me that extra return? So just to recap here, guys, let's talk about bonds a little bit more. Bonds are money you lend to corporations or governments in exchange for a certain amount of money. You lend them for a certain time frame. Depending on the credit worthiness of that borrower, that is going to determine your yield. And you buy a bond or bond ETF through an exchange. Now, how does this fit exactly into the stock market and real estate market? Well, the stock market loves lower interest rates, i.e. bond yields being low. Why? Because that means corporations are able to borrow money cheaply and grow their business. So if you're able to borrow money cheap and grow your business, well, that's good for the stock market, okay? So generally speaking, stock market likes lower interest rates, lower yields. Same thing with the real estate market. Now, real estate market, generally speaking, if you look at your 5-year bond yields, that very often translates to what is being offered as a 5-year fixed rate mortgage, okay? Now, variable mortgages depend upon actual Fed funds rate or the Bank of Canada rate, okay? So they'll have the Bank of Canada rate, Fed funds rate, and then they'll tack a certain percentage on top, and there is your variable rate, okay? So bonds play a big part in determining what 5-year fixed mortgage is going to be, and also explain what variable rate mortgage will be. Now, obviously, when interest rates are higher, that causes pressure on the real estate market. So understanding bonds, as boring as they may be, will make you a better investor in the stock market and the real estate market, and that's what it's all about. It's about being an educated investor and then applying that knowledge. I hope you guys like this video. A bit boring, I know, but important. And let us know what videos you'd like to see in the future. Omar Khan here from Theta Trading, guys. Take care and talk soon.